Should I do interest only or principal and interest loans on my investment loans? This question is forever asked throughout the investment world. So which one do you choose? Does interest only decrease or increase serviceability? Or do people say this because they just don't have the understanding behind lending? If you're serious about building a property portfolio, then make sure you watch to the end and take notes. Trying to navigate the property world is not easy with a lot of misinformation out. So what I want to do is I want to break down for you and clear the air. Hopefully by the end of this, you can be well on your way to learning how to treat property like a business. And if you haven't already, make sure you click on the follow button below and also let me know your problems in the comments you have on your journey and I'll create a video for you. How much effort will you put in? What are you willing to do to get there will determine how far you go. A little bit about me. I'm Scott Lavoon. I'm the founder of Wealth Through Property. I started investing in property at the age of 30 years old while working a full-time job as a tradie. I wasn't on a big income, and within the space of 3 years with the right mentors, I was able to build a system where I was able to retire with over 10 properties and over 100,000 in passive income. So it's time for you to go and get a loan, and you don't know which one to choose. And you don't know how to choose what type of loan is best for your situation. Interest only, first principal and interest loans are two different options that you can consider. But the problem is, it's not as simple as you just choosing one or the other, because there are many different factors that will play into what type of loan you should take out. What is the difference between interest only and principal interest loan? Let's first understand what interest is. Interest is the amount of money a lender or a financial institution charges for lending out money to a party. Essentially, interest is money a lender gets for loaning out money. They usually express this by adding a percentage onto the amount of the money that is borrowed over a monthly or annual period. This will be based on the amount owing and the length of time in days, months, or years. Your interest for a home loan is generally calculated daily based on the outstanding balance of your loan. Let's take a basic example. If you got a $100,000 loan, but you never paid off the loan and you only paid off the interest. For this $100,000 loan, the lender wants to charge you a 5% per annum interest rate. How much is 5% off of the $100,000 loan? Well, that's about $5,000 a year in interest, or $416.67 per month. So that is a fee you would have to pay back every month of $416,067. If you never paid off the loan, then your repayments would never change unless you increase the loan amount, which in this example, we didn't do. The next step is to understand principal amount of the loan. The principal amount is the part where you have to pay the actual amount that you owe. Obviously, a lender is going to want you to pay back the loan at some point. You will pay back the loan over a set period of time. This is usually determined by the agreement that you have with the lender. In the case of property loans, your period is generally set at 30 years, which is the typical lifespan of a mortgage. So how does this work with interest only and principal and interest loan? The main difference between these two types of loans is whether or not you'll be paying back the principal amount or just the interest. With an interest only loan, you'll only be paying back the interest component of the loan. This means that when your payment period ends, you will still owe the same amount as when it began because you never paid any of the principal off. A principal and interest loan is a different story. With this type of loan, you'll be paying back both the interest and the principal. You are not only just paying back the interest on the loan, you are also paying back a small amount of the principal, which helps you reduce the debt over time. It's a good feeling knowing that your loan is being reduced even while you're making the repayments. If we stick with this $100,000 loan example, then 5% per annum on the loan amount with a time frame of 5 years, what your repayments will look like. This is where repayments get interesting. Remember, your interest rates are calculated based on your loan amount. Looking at our loan schedule, you can see our first interest repayment of $416.67 on the first of the month, and a principal repayment of $1,470.66, which is a total amount of $1,888.12. Also, you can see here, as you start to pay off the loan, the interest rates drop while the principal amount goes higher, but the actual repayments you make are still the same every month of $1,887.12. If you calculate all the 60 months of the 1470 and 66, you will find it's an equal amount of $100,000. And if you calculate how much interest you would have to pay, it equals $13,227.40. The biggest difference, obviously, than just getting a loan on the investment property is that we know that we are going to get rent coming in each month. So now, either a proportion of the loan or the whole amount of the loan is getting covered by the rent. This will heavily change depending on your rent. Now, we understand the difference. Which one do we choose? Disclaimer, this information is of general nature and not to be taken as advice. Make sure you seek professional advice before making any financial decision. This is really going to be based on a few main factors such as your goals, buying strategy, lending strategy, accounting strategy, and exit strategy. For a start, we never recommend doing anything without you building goals first and then having a solid strategy and multiple exit plans when moving forward. A mentor who has achieved something big is a good start to helping you build goals and a strategy. The most important part is to understand that every decision you make has a financial impact. So it's really important to have the right information. What are your goals? Buying strategy and exit plan. How many properties do you actually want to buy over the next few years? Are you going to get positive or negatively geared properties? Will your rent cover all the mortgage repayments if you do P&I versus interest only? Are you going to be stretched financially? Do you want to build a big or small portfolio? How are you going to pay the properties off? I can't pay a property off if it's interest only, so this starts to look like a bad idea to start with. You may start to look at the question and say, why would anyone ever want to do interest only? The answer is inflation. What is inflation? Inflation is a rise in prices of goods and services. The most obvious example is a loaf of bread for $1 today, and in 5 years' time, it might cost $3.50. With the cost of living going up, so do wages. And the best thing about property is that it rises with inflation. Generally, properties have an average growth level of 7% compound growth per year. So, a property bought today for $500,000 may be worth $1 million in 10 years' time, and will still have a mortgage of $500,000. I know what you're gonna say. It's great that your property has gone up in value, but there is still the fact that the mortgage hasn't changed, moved, or been paid off. You still have the $500,000 loan. What if you bought two properties at the same time instead of buying one? Is it unreasonable to think that in 10 years' time they will both double? Could you sell one to completely pay out the second? Now, you're starting to see a strategy being built here. We call this the double up method. FYI, by the time you factor in taxes, it's close to the 12-year mark. You could pay out one to keep another. For this example, we're going to say 10 years. There is also a benefit of doing the double up method on interest only. If your rent covers the interest repayments and more, now you're running at a loss on this property. I know what you're going to say, but the value of the property will go up. So would you pay interest only on your principal place? So we obviously said above that properties grow over time, and realistically, do we need to pay off our principal place residence if the other property grows in value and can pay this off? This is where we bring the accounting side of things in to make a decision. The one thing we understand about investments is that they are tax deductible, while your principal place of residence isn't. So you can't claim tax on your principal place of residence. When we say tax deductible in terms of the loan, we mean you're able to deduct your interest repayments off the investment property, but not for the principal place of residence. So say we introduce the $100,000 we previously mentioned. I know you can't buy a property for $100,000, but this is just an easy example. We know that over the 5 years of being on principal and interest, you're going to pay $13,227.40 in interest. Imagine if we change the loan to interest only, which means we pay $416.67 per month, which is now $25,000.02 in interest over that 5 years. If we redirected the principal repayments to the principal place that we would have paid on the investment property, we would start to reduce our non-tax deductible debt. This is where you need to understand good debt versus bad debt. Good debt is when you have two qualities. Firstly, the interest is tax deductible. Second, it'll appreciate over time. If the debt doesn't have both these qualities, then it's referred to as bad debt. Generally, people don't want to pay off good debt, but they will pay off bad debt quickly. Though, if you have one of the other qualities, then you may head down a different strategy altogether. So you start to understand that your principal place of residence is bad debt due to the fact you can't claim interest on it, but your investment properties are good debt as they have all these qualities. You need to also consider that the banks will have two different interest rates depending on whether you're principal and interest or interest only. So your principal and interest rates will be lower than your interest only rate. Where say you get a 5% on principal and interest, it may be 5.5% on interest only. You also have fixed or variable rates, which will also affect the interest rate that they charge you. There's no one size that fits all, but as we've said before, it's important to do your research and understand the advantages and disadvantages of every decision you make. How does interest only and principal and interest loans affect your lending when you want to move forward? How many times have you heard that interest only increases or decreases your serviceability? I know, mixed information, right? One guru says it reduces, while another says it increases. What if they were both wrong, but both right at the same time? This is why I like to explain this. With interest only, you're paying less on a monthly basis for your repayment. But does this mean banks see this as a positive or a negative? It's really important to understand that there are many different types of banks out there, all with different lending policy. There is also a difference between tier 1, 2, and 3 banks. Let's split the banks into two types of banks: those that forecast repayments and those that take actual repayments. If a bank takes actual repayments, then your serviceability will be better with interest only. However, if a bank forecasts your repayment, then it's going to be different, and paying principal and interest would be better for increasing your serviceability. A bank that is taking actual repayments will review the interest only loan and see that you're paying less, which means you have more cash flow available to service other debts. While a bank that forecasts will say your loan is over 30 years. After your 5 years, your interest only term will be up. Your loan amount is going to be the same. So when we switch you from interest only to principal and interest, your repayments are going to be higher than if you originally went with principal and interest. The banks will take your repayments as if you were a 25-year loan term, as the principal of the loan will need to be paid off over the 25 years instead of the 30 years. Where this type of banks, if you did principal and interest from the 30-year loan term, it's less than if they considered it as a 25-year loan term. One important factor to consider though is when building a portfolio is cash flow, as without much cash flow, you'll only be able to go so far, and you'll only be able to look after a certain amount of debt. If your property is negative geared, you're purely relying on the equity and the differences between what you've paid for the property and what it is worth now. But if you want to be able to purchase more properties and make bigger profits in the long run, then interest only is definitely worth considering. Either way, it's important to chat with a mortgage broker who understands your individual situation, as they can guide you the right path best suited for you. It's also important not to make any hasty decisions that will affect your long-term goals, so it's always best to do your research, understand the pros and cons of each strategy, and then make an informed decision. I really hope you enjoyed this guide on how to start when looking to build your team and start your property journey. Please follow, like, share, and comment if you got value, and stay tuned for more.